goes, well begun is half done. So in January, between probably the first week of January and the end of January, you're going to get a lot of forms in the mail. You get your W-2 from your employer, you get 1099s from people who have paid you money, you get your 1098s and such. So you want to keep all these documents, you want to collect them and keep them in one place. A lot of people have a drawer or some sort of clip or anything. I prefer the almighty manila envelope. The reason why I like the manila envelope is simply you put all your tax stuff into it while you're gathering it during the month of January. And then at the end of the day, you take it out, you do your taxes, you get rid of all the excess envelopes and paper, but then you can print your tax returns and now put your tax returns in there. And so you have all your documents and a set of returns in that one same envelope. So first thing is get organized, because you're going to need to keep a whole bunch of stuff. So you're going to get your W-2s from your employers, you get your 1099s. 1099 interest is what you get from banks. 1099 dividends is what you get if you have dividends on stocks and such. In addition to that, you're also going to be getting paperwork regarding your deductions. If you have a home, a home loan, you have what they call a 1098, and you can deduct that off of your Schedule A. We'll get to that in a minute. But you'll be getting all these documents in January. Please keep all these documents. Figure out a place, wherever place is most convenient for you, but it's just so much easier to do it if you've gathered all the documents ahead of time. Okay. My opinion is you can file your taxes early. The main reason why, well, two things. Even if you owe money, you can file early and you don't have to pay until April 15th. So don't think that you need to have to pay when you file, because if you owe, you can actually file in February and then pay April 15th. But what you're going to want to do is see if you have FAFSA that you have to fill out, the free application for federal student aid. The earlier you file, the earlier you can do the FAFSA. And also to see if you qualify for the Earned Income Tax Credit. It's called a refundable credit because you don't have to have paid anything in to get money back from the government. I use the term EIC because that's what it used to be called. They threw a T in there for some reason, which makes sense. We used to call it Earned Income Credit, but now it's Earned Income Tax Credit. So, okay, so sooner the better. Just if you end up owing, you can plan better. So the sooner you know if you have liability, it's good. It feels good to get them done. So in order to get them done, set a date. It's always good to have a target date. So say, okay, I'm going to work on my taxes, and get them done by, February 20th or whatever. Maybe it's March 2nd. Pick a date, pick a weekend, so that at least you have a deadline, because deadlines are energizing. For those of you who don't know, traditionally April 15th is tax day. If it falls on a weekend, it is the next business day. You can also file an extension, but remember, the extension is to file your taxes, not pay your taxes. So even if you file an extension, if you think you're going to owe, you're going to have to pay everything you owe on April 15th, or what you think you owe, to avoid a penalty. Moving on. When you pay your taxes, generally there's 3 ways to pay your taxes. The first way is with your return, but if you don't pay enough during the year, they don't like it. The second way is if you have a small business, you're familiar with little quarterly tax payments. But most of the time, you pay your taxes with your employer. So your employer every week or bi-weekly or twice a month or even once a month if you work for the state. You get your paycheck, and out of that paycheck, your employer takes money. You fill out a W-4 to tell your employer how much of your paycheck you'd like to set aside to pay your taxes. So a word about tax withholding. Generally, I intentionally over-withheld because number one, when I file my taxes, a refund encourages me to file my taxes. So even me, 30 years later, I still, to do my taxes and then to have to pay when I do my taxes just stings a little bit extra. So there's enough sting in doing my taxes that I intentionally over withhold so that I always get a refund, which encourages me to do it earlier in my life. So like I say, if I owe tax and I'm not expecting it, it can be a budget buster. And then for those of you who, well, I've done taxes for friends who haven't done taxes for a while, and to realize that tax penalties are based upon the amount you owe. So for instance, we talk about that automatic extension. So for instance, if April 15th comes around, your life is in shambles, you can file an automatic extension. And as long as you've had enough tax withheld, extending your filing date to August 15th doesn't hurt you as long as you don't owe. If you file an extension because you don't really know what's going on and you end up owing, you'll owe a penalty on top of the additional taxes that you owe. But if you over withhold and life falls apart and you file the extension, then guess what? At least you won't owe a penalty when you eventually file that tax return. Those of you, there's a lot of people that say, hey, you should under withhold because, in other words, you're giving the government an interest-free loan. Yes, I know I'm giving the government an interest-free loan, and I'm okay with that because I don't want that budget-busting tax obligation. If I file an extension, I don't have to worry about the taxes that I owe. If I'm filing extensions because for some reason I don't have enough information to do so, and therefore, and in general, I don't like to owe anybody anything. So yes, I know I'm giving the government an interest-free loan, but I'm okay with that for these reasons here. So this is your W-4. W-4 is what you give your employer. So if you go to work for any employer, you'll fill out this W-4, put your name, and then here you've got single, married jointly, and head of household. So how this form works is that if you file married, filing jointly, it'll assume that it'll cut your income in half because half of your income will go to your, scratch. If you file single or married filing separately, if you are single, you have the highest tax withheld. And if you're married filing separately, you'll be taxed on 100% of your wages. If you are married filing jointly, it assumes that you're a single income household and therefore cut your taxes in half. So you'll have less withheld with married filing jointly than you will with single. And then head of household, for those of you who are single and have a kid, you know you get a preferential tax rate, and so it would be appropriate there. So if you want to have the most withholding, you select single. If you want to have the least withholding, you select married. If you want to increase your withholding, you have a small number of dependents. And if you want to decrease your withholding, you have a large number of dependents. If you are, like I say, married and you and your spouse work, you'll probably each want to check the single box because that will withhold more. Like I say, the married filing jointly assumes that your income will be in essence cut in half, split between you and your spouse. The larger number of dependents you have, the larger exemptions you have, and the less tax you pay. Smaller number of dependents you have, the more tax you will owe because you'll have less deductions. So all this is just simply estimating how much tax that you'll owe, and therefore you'll have the appropriate amount withheld from your paycheck every month, or every week, or every other week. Okay. W-2, so this is what you will get from your employer. You'll have your employer's information, your information, and then you'll got the wages and tips, and then your taxes withheld. So we have got federal taxes withheld, we've got state taxes withheld, Medicare is withheld, and then you've got your state boxes down here. So state income tax will be withheld in box 17. There are normally for you guys, probably all these boxes might be the same. If you have things like a 401k deductions, you'll not be taxed on some of those other wages. So you'll pay Social Security tax on your wages, but you won't have to pay income tax on, say, for instance, your 401k. So that amount will be deducted from here. If you receive interest or income, if you receive rents, other income, if people pay you as an independent contractor, you'll get a 1099. 1099 interest is interest, dividend is dividend, R is retirement. If for some reason you're getting a retirement benefit or a distribution, you'll get a 1099-R. But your 1099 classifications are just other income you're probably gonna have to claim on your return, the people that pay you money. 1098s. 1098s are things that you have paid. A lot of students here will get a 1098-T. So you'll be able to deduct something on your return when you get a 1098-T. This is generally the paperwork that you use to fill out your forms and to get something back. So if you itemize, we have a 1098 for mortgage interest, and then you won't, everything that you get to deduct on your Schedule A, which is your itemized deductions, doesn't come necessarily on 1098. You might get some statements from organizations you donated money to, but they won't be on an official form. Generally, it's a letter saying, hey, thanks for the donation, save this for your tax records. So this is the final product. This is a 1040 from the IRS. This is a form that you're going to fill out. There's 1040 EZ if you qualify for EZ filing, but this is the form that we're looking at to file. There's also one for the state. So with the state of California, you basically include a copy of your federal return with the state. And so you have a state return that's a couple pages, then you'll include your 1040 with it, or 1040 EZ with your state return when you file with the state. Here, it should be self-explanatory. This is your filing status up here. So this is your real filing status. This, if you're married and you're filing jointly, you click married filing jointly. So yeah, this is the real, while we talked about the W-4 ahead of time, this, it's just, that's a tax estimating tool. This is your actual return. So you've got Social Security numbers here, your dependents, kids, and generally sometimes if your parent lives with you and you provide more than half their support, you can claim your parent as a dependent. That's important if you're single and wanting to file head of household. It's always good to have a dependent. Well, you need a dependent to do that for essence. So you have your wages here. So if you're filling out this form by hand, you'll be putting in your W-2 wages. So you take it, box 1, you put it here, and then you go down, and here's the math of the form. So page 2, calculate your tax, and then all your tax payments, your withholding, and then we come up with a refund or the amount that you owe. So you either have a refund, and then or on line 23, you'll have an amount that you owe. You sign it, you date it, you send it in. Schedules. So on your tax returns, you'll have, if you itemize. So you can either itemize, or you can take the standard deduction. When the standard deduction was smaller, oftentimes many people had itemized deductions that were higher than the standard deduction, so you took your itemized deductions. Today, because of the Trump tax plan, he substantially increased the standard deduction, so a lot of people will not even be filling out Schedule A's because the standard deduction is so large and they don't pay enough of these other things in order to take the itemized deductions. So your standard deductions come in, let's see, right here. So you've got your standard deductions and your itemized deductions. And so if you're single or married, you got $12,000 worth of standard deductions. If you're filing jointly, it's $24,000. Head of household, 18. So if all of your state taxes you paid, all of your interest you paid, all of your gifts to charity, if you're married and if you're single and that's under 12,000, don't even bother. You'll just take the standard deduction and you won't be filing Schedule A. But for those that will, this is what you'll be doing. You'll be filling out the Schedule A. The medical and dental expenses have a floor, so you have to pay more than 7.5% of your adjusted gross income before you can deduct $1. So unless you have a significant medical expense, nobody declaims medical and dental expenses. And then there's a similar thing for, if you have to fill out a different form for your casualty and theft losses. So here is where you would deduct all of your taxes, income taxes you paid, property taxes and stuff, interest from your home on a 1098, and then if you made charitable donations. So that's the main 3 categories that people fill out on Schedule A. Schedule B is just simply a place where you can summarize. Part 1 is all the interest that you received. Part 2 is the dividends that you received. So if you have some stock, you get some dividends, you get 1099 div, you'll put it on here. If you have an account with a financial institution, you get your interest up here in Part 1, and that's Schedule B. Schedule C is a profit or loss from a business. So if you have a side hustle, if you've got something going on that you have a bona fide Schedule C business, it's not a corporation, it's not a partnership, it's just you kind of hanging out your own shingle. Here is the form that you would use to record all of your information on there, your gross receipts, then all your business expenses, and then you would carry forward your net income. Businesses do qualify you to pay Social Security tax on that business income. So it'll take it to a place on the form that calculates that Social Security tax for you. If you have a rental, this is Schedule E, and I can't remember what Schedule D was, but we just skipped right over it because it's very unlikely that you're going to run into it. But if you have a rental, here is where your rental properties are. So here, if it's a single family residence or whatever, and then you've got your rents received and then all the expenses for your rental. And then down here, you've got, the total that we carried to the next form, back up to your 1040. Okay, so if you need help filling out stuff or you need information, the IRS.gov website, it's a very good place for information. It's got, well, first of all, it has all the forms that you need. And oftentimes, if you're confused, all the forms have instructions. So the quickest way to figure out how to fill out a form is to download the instructions when you're looking at the form so that you can actually read the instructions, because they do tell you what you need to know. If you have questions concerning about taxable and non-taxable income, the IRS has a publication 525. And if you pull that off, it's, 60, 80 pages. It goes through everything that's what's taxable, what's non-taxable, the classifications of income. And it's, if you want to dig deeper into it, the IRS publications are pretty good at letting you know what you can and cannot deduct. There's a publication for small business, and there's a publication for practically anything. So between the forms that you think you need to fill out and the instructions for those forms and the publications, you can generally get most of the information you need from the IRS itself through the irs.gov website. Okay, so, but for you guys, hey, I just want to file my taxes. This is Hassan Miha. He's a guy that did it. He does a Netflix show. Basically, he has a website. It's called turbotaxsucksass.com. It's a very good resource. When you go there, it will have all the people. Okay, so long story short, because the IRS said, hey, we're going to do this electronic tax filing, if you want to participate, you're going to have to provide free tax software to the general public. So, what they do is, here, let's go back to here. But if you go to their website and you try and find that free tax service, they have all these roadblocks. Of course, they're going to try to do everything they can do to get you to pay. All tax companies that file with the IRS, number one, have to provide electronic filing for free. And that's why if you use any tax software, the federal form is always free. And that's why they charge you $25 for the state form. And second, they hide their free tax filing ability, because after all, why would they, if they can get you to pay because they can, why wouldn't they? So he went through, I watched his little video a long time ago, but this is his website. And the reason why I put it up here is, if I give you a website in TurboTax, it may change between now and April 15th, and I'm sure he will keep his website up to date. So that's why I gave you his website. So here, it's not only TurboTax, there's a ton of other ones, Tax Act, Tax Slayer, H&R Block, Easy Tax Return, everything. Now, there's a little bit of difference between who will let you file free and not, but if you go to his website, turbotaxsucksass.com, you're able to click on each and every link and take a look and see they spell out who they're going to let file for free. So make sure that if you think you can file for free, make sure you fall within their confines. But everyone's got a little different spin on it, so you're going to have to kind of read the page and see what they need to do there. So where were we? So anyway, so sometimes they say, oh, you can't make over 36. Other people say 59. If you're military, making 69 or less, if you qualify for the earned income tax credit. So there's all these like ifs and ands statements, but go there, take a look before you start to make sure that you can do the free file. It's kind of strange how they all have different requirements, but I'm sure they've read the tax law and think, oh, this is okay. But anyway, so that's the end of my presentation. Wanted to make sure I left plenty of time for questions. So with that, Isabella, do we have any questions?
Yes, so thank you so much for your presentation. So yeah, we'll be opening the floor to questions now. And I have received some already, but if anyone has any more, please keep sending them to me and I will read them aloud. So first, we have a question: up to what age is considered dependent for children?
Okay, so a dependent is somebody who you provide more than half of the support. So oftentimes, and obviously anybody who's living with you in your household is generally a dependent, and anybody under the age of 18 can generally be claimed as a dependent. Students, if you're providing more than half of the support for a student up through age 26, you can claim that person as a dependent. However, if that person's already working, they provide their own support, then they're no longer dependent because you're not footing their bill. So dependent is basically anybody who you're related to who you provide more than half of their support. If you have an elderly parent that's living with you, you can actually claim that elderly parent within certain criteria as a dependent.
Perfect, thank you so much. Next, we have child for credit and child for dependent. Could you please tell the difference?
Okay, so a dependent is obviously someone you provide the half support for. If you have a dependent and you don't make a lot of money, you can do a income tax credit for that child. That's where we got the earned income tax credit. The earned income tax credit just simply means you get so much money from the government no matter how much you made when you file your tax return. It's a credit that appears on the W-4. If you're in this situation where you have the earned income tax credit, where you have a child that may qualify and you're a person of modest income, by all means, go to a free site and use the tools that they give you for free. So go to that site, click on TurboTax, H&R Block, Tax Act, Tax Layer, and then go through their process, and they will automatically show you, okay, you put in your information, you put in who your kids are, answer a lot of questions in those automated tools. And the reason why the tools are used is because they do simplify, and they walk you through the process on a question by question basis. So there are some technical definitions that it doesn't make sense to get into because you're really going to need to go into those websites and kind of answer those questions as you go through. Last year I used TurboTax. I've been using TurboTax for quite some time. And when it'll walk you through a lot of interesting questions. But if you answer them correctly, then basically you're going to get a good return. Because your return is so simple, the questions really won't be that complex. But yeah, generally the children for dependents are the same children for the earned income tax credit. If you're a person who's divorced, you might have a marital separation agreement that stipulates who gets to deduct the children for what. That you'll have to refer to the actual agreement. Other times, and there are forms that you fill out to say, okay, the kid lives with me, but I get support for the kid from him, and we've agreed that he gets a deduction, and blah 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 blah. So I can't, you have to. If you're divorced, you got to look at your divorce decree and figure out, who gets to claim the kid. But that's, I think, beyond the scope of today.
Awesome, thank you. Next, we have how much is the percentage of donation to the income that makes a difference in taxable income? The same with medical expenses.
Got it. So as we said on the form, if you are married or single or married filing separately, 12,200, right? So this is the standard deduction. This is what you can write off your taxes regardless of how much Schedule A stuff you have. If you have, so you go to your Schedule A. So if you you know, if you take a look at your W-2, you'll have state taxes that you paid. If you have a 1099, this is the interest that you pay, and your gifts to charity are down here. The total of all your deductions has to be more than the 12,200. Otherwise, you'll just claim the standard deduction. You know, why would you claim itemized deductions from Schedule A when you could just claim the standard deduction, and that number would be higher? So the question is, obviously, if you donate more than 12,200 to charity and you're single, then you can use this form and you'll be able to deduct that entire amount plus all these other things. But it's a combined total of everything on Schedule A that comes forward to this line item here, right? And so if this, you know, if you're married and you've got $18,000 worth of Schedule A, but look here, you got 24,400 to deduct here, which would be larger than your Schedule A deduction. So you just ignore your itemized deductions and put the 24,400 here. So truly, unless you're a higher income person earning a lot of money, you paid a lot in state income tax, and you have a house that's got a pretty good property tax bogey, you're probably gonna just end up being itemized deduct. You probably end up taking the standard deduction and not worrying about the itemized deductions. But you may, that's why we're talking about today, is I just want to make sure everyone was aware that there's a thing called the Schedule A. It's where you itemize. If you got a lot of things to itemize, then yeah, you'll be able to make that deduction on your tax return. Medical and dental expenses, they are, you have to hit a floor in that. So for instance, here you've got, well here, the form pretty much says it. So on line 2 of the tax form, so you've got your, all your, no, that's an old form. You have to have more than your income. Okay, so let's get, so say you made, I don't know how much you want to make. Say you made 50,000. So you take 7.5% of that, and you deduct that 7.5% from your gross medical expenses before it even shows up on this form. So if you have 50,000 and you had 7.5, you know, that's what, that's called about 37,500. If you made a, yeah, 37,500 if you made, excuse me, 3,750 if you made 50,000 that you'd have to exceed. So unless you have a significant medical event, you probably won't get anything from your medical and dental expenses. If you're older, and for instance, you have mandatory care or whatever, you know, you're taking care of, or you're now in a convalescent home, or you had an extended hospital stay where the medical bills were through the roof, then you might deduct something on Schedule A. But for instance, if you just had, you know, your teeth cleanings and you went up for a, you know, you had, you know, maybe a cold that you went, or, you know, some birth control, whatever that is very minimal, you're probably not going to be able to deduct that on your tax return because of this floor here. So line 8B. So you go back up to line 8B, which is all your wages, everything else that you've done up here to adjustable gross income. So before you take your deductions, your adjustable gross income is generally your wages and all the other things that you have had. And then you get to, this is the 7.5% of all of your income that you'll have to reduce your medical expenses by before you even get to deduct anything. Does that make sense?
Yeah, we just have one.
I hope I haven't overcomplicated it, but.
Oh no, yeah, I think you're good. We have one follow-up question though. Someone asks, so if the donation is low, it will not make a difference, correct?
Correct. So, you know, let me put it this way. If you have, say you're single and you have $15,000 worth of taxes and interest, then anything that you give will add to that 15,000 so you can deduct it off of your tax return. But if you don't have much in the taxes and the interest that you paid, then, you know, you'd have to have a pretty big gift to charity to get you to that standard deduction floor. So yeah, I mean, like I say, if you have enough of other things that get you beyond the standard deduction, then anything you give to charity is deductible. Depends upon what your tax situation is.
Okay, awesome, thank you. Apologies for my dogs barking in the background, but yeah, the next question would be, this is a question regarding federal work study. Do we need to
Yes,
file this as income? Is it taxable income, or is it a grant like Pell Grant or Cal Grant?
I have no idea. So you're going to have to do a little bit of research. Obviously, if you use one of the tax preparation software, they will walk you through that process. But quite frankly, I have no idea. I think if you, if they issue you obviously a 1099, then it's probably going to be taxable income on the 1099 form. They pretty much, let's see. So here on the 1099 form, they sometimes indicate what's tax-free. Obviously, if they withheld tax, it's pretty well taxable. So if you get a 1099 and it's under 3 other income, yes, it's going to be taxable. On the, yeah, so other than that, you'd have to take a look at, perhaps, if you want to get a jump start, you can read that IRS publication I talked about earlier. Was it 525? That IRS publication 525, that's tells you what's taxable and what's not, and you can kind of maybe get a good idea from that, but wherever that suggestion was. But yeah, so here we go. So I would read 525. That will give you an idea if it's taxable, and then obviously if you use one of the tax preparation software, they'll answer those questions and they'll know if it's taxable or not.
Perfect, thank you. Our next question is, could you define increased/decreased withholding?
Correct. So here, so it's a little bit counterintuitive, right? So the smaller number of dependents you have, the more withholding that they will take. So the more dependents you have, the less withholding that they'll take. So for instance, if your paycheck is, say, it's $2,000, right? If you select single and 0 dependents, they'll take, 300 of that 2,000 because that's the tax that you're going to pay. If you select married and 10 dependents, they'll only take, 50 bucks. They'll take less out of your paycheck. So increasing withholding means they're taking more out of your paycheck. Decreases withholding means they'll take less out of your paycheck. So for instance, if, and sometimes, if you don't really know, do you want to err on the side of over withholding, which is they withhold a lot more, or under withholding. But that's just, because it's counterintuitive, the more dependents you have, the less withholding that happens. The smaller number of dependents, the larger withholding happens. So I just wanted to kind of give people the idea is that if you want to make sure your withholding is sufficient, select single, put in 0. Then you'll never have to pay when you file your taxes if all you have to worry about is yourself. If you're truly married and you need every dime that you can, and you know that your spouse doesn't work, then select married and fill out the dependent section accurately, and you pretty much should be on the dot for how much tax you're going to owe if that's your only income, right? If you have a significant amount of rental income or interest income, you're going to need to go, you're going to have to, you can either pay quarterly tax payments or with your return, or you can just have your employer take it out of your paycheck so you're paying it as you go. So for instance, even though, if I have if I'm getting a lot of interest income for some reason, I may want to increase my withholding so I don't have to pay when I file my taxes. Therefore, I could tinker with my filing status, these 3 boxes here, or I can tinker with my number of dependents. This form here, it just simply, it tells you, your employer, which table to use when they're withholding tax. That's all it does. So hopefully that answered the question.
Yes, thank you. Next, we have a lot of people received EDD money. How will they be filed?
There is income tax owed, I believe, on EDD money. I haven't done it, so I don't know where it pops up on the form, so I can't really, I assume it's somewhere. off the top of my head, I just don't know where.
Okay, awesome. Yeah, no problem. Someone says during the lockdowns, they lost their job and went to school full time instead. Will they need to file for the few months that they did work, or how does that work? Are there new rules as of now?
Yes. Yeah, absolutely. If you get a W-2, you'll probably have withholding on that W-2. And if you don't owe any income tax, you're going to want that back. So to file a 1040 is a way of getting that tax money back from the government. And if you did that, you may also qualify for the child tax care credit as well. So now I look at the 1040 form before we have this. So like I said before, you could have a parent be on here if your parent lives with you and you provide more than half your support. So you would not check the child tax credit box, but you would check the other dependent box. But generally, if you have a child, you'll check both boxes, child tax credit and other dependent box. So your kids will have both boxes checked. If it's somebody other than a child, then you'll probably only check this other dependent box. Got it.
Okay, and if someone has kind of like a follow-up, they see EDD unemployment benefits. Would we do this money as income?
Correct. Yeah, I believe they still have you pay tax on unemployment income. They focused on the income part of unemployment income, so.
Perfect. Okay, thank you. Next we have do we free to choose the filed status? For example, can married select that she is single?
On the W-4, yes. This is not binding. This is just what table to use. On the 1040, no. You have to put yourself in the status that you are.
Okay, awesome. Next we have, under what condition can a teacher invest in Roth IRAs? Teachers normally invest in 403B, and income from teaching can't be invested in Roth IRAs. However, if you are a teacher, can you invest other income such as income from dividends or sales of stock into a Roth IRA?
I'm going to go with yes. For those of you who don't know, I believe even teachers can qualify for Roth IRAs. Roth IRA is a tax-deferred investment tool, meaning I have income. I will pay income on that tax today, but I will set it aside for my retirement. So it doesn't shelter today's income. You actually pay all the tax on that income, and then putting it in the Roth IRA just simply means anything you make inside the Roth IRA is tax-free because you've already paid tax on that income once. So, and you're setting it aside for your retirement, so you can take it out in retirement tax-free. Don't quote me, but memory serves me correctly, I think even teachers can do Roth IRAs because it's with after-tax income. Does that make sense? So normal IRAs, you get to deduct from your tax liability because it's pre-tax income, but Roth IRAs are post-tax income, but then anything that you make in that IRA, in that Roth account is tax-free.
Okay, great. Next we have, how do taxes work if we are retired here but live overseas?
Okay. Generally people have a tax domicile. In other words, you are considered to live in a place for tax purposes. Mostly this has to do with like states. Where are you, quote, domiciled? It's just a tax term saying where do you live for tax purposes? For instance, a lot of people, quote, domicile in Florida or Texas simply because Florida and Texas have no income state tax. So there's rules for where you're domiciled. Generally, the main rule is where do you spend half of your time or more. So if you live half of your time in Texas and or 3/4 of your time in Texas, you're domiciled in Texas. If you live 3/4 of your time in California, then you're domiciled in California. If there's no one spot where you live more than half of your life, then you gotta go through the rules, and sometimes you get to choose, and people choose the states that don't have tax liabilities. If you're an expatriate, which is somebody who's a US citizen living abroad, I have no idea. I've never done US patriot stuff. I believe you still quote owe federal income tax if you're a US patriot living abroad, but there's deductions and there's all sorts of interesting things that if you're working, but since you're outside of the US, you don't owe any state income tax, because that doesn't make any sense, because if your tax domicile is outside, you wouldn't owe any state, but you might owe federal, so you'd have to at least go through the form to see how much retirement income you have, right? If you're married and you have under $24,000 in retirement income, per the standard deduction, you're not going to owe anything. So depends on your tax situation, you may have to employ a tax professional.
Thank you. Next question asks, what are the advantages and disadvantages if the tax credit being introduced by President Trump goes through?
I'm not familiar with what he's proposing. Obviously, so you've got things that you can deduct, which are things that you take off of income, and you have tax credits, which reduce your income tax liability. So credits are better than deductions. And then you have what they call a refundable credit, which means even if you didn't pay any tax, you get that money back regardless. So the earned income credit for kids, the earned income tax credit for kids, that's a refundable credit. You don't actually have to pay any tax to get it back. A lot of other credits that happen for businesses or for sometimes there's a HUD does a mortgage credit. You know, say your tax liability was $3,000, you get $1,000 off, so you only pay $2,000. So tax credits impact your tax liability directly. Refundable tax credits mean you can get money back directly into your pocket. Deductions just simply mean you're reducing your overall income, so you don't pay as much tax on the income that is being reduced. I'm not familiar with what she's referring to on the Trump. If she elaborate, I'd be more than happy to weigh in as well.
Okay, great. Yeah, thank you so much. Next, if I want to get more tax returns, can I put less dependents for my pay period? Parentheses, though I have more dependents, and during tax return claim those dependents as more credit?
Correct. Once again, the W-4 is simply an estimate of the tax you want withheld on your paycheck. So you can put down here on this form whatever you want, because the declaration here is, you think that this is what you want withheld. This isn't a picture of who you are necessarily. This is just simply how much you want withheld from your paycheck each and every pay period. On the tax form, obviously you have to be accurate on the tax form, because this is what is really the situation. So if you, for whatever reason, would like to have more tax withheld, you can easily decrease your dependents and have more withheld. If for instance, you know that, here's a good example. Say for some reason, okay, you're going to be working 6 months, right? And then you're not going to be working for the last 6 months. In that case, you may make your this number larger, make your dependents larger, so you have less withheld, because when you file your tax return, because everything is kind of done on an annual basis, you really have half the income that you normally would have had. So you may increase your dependents here because you're only going to be working for part of the year, and you'd rather have that money today than have to file a return and get it back. Does that make sense? So there are reasons why you would have more dependents than what you actually have. Like I say, if you only plan to work half the year. On the other hand, if you want more withheld, you just simply decrease the number of dependents on this form. Like I say, this is just an estimate of what you want withheld. It matters to your employer because it just tells them what table to use when they implement through their payroll system your withholding. Here is the real deal. You have to exactly say who it is and what you're doing.
Perfect, thank you. Another person asks, so the EDD income gets added when we file our income taxes in April?
Okay, so you'll get something from the EDD. It'll be a form. It'll have a form number. You go to TurboTax or another tax preparation software. You fill in that amount, and it will figure it out for you. That's the best I can do today. How much is taxable? How much is not taxable? I don't know. It'll depend upon your individual circumstance. But I do believe, if memory serves me correctly, that yes, you will pay income tax on your unemployment benefits. You might even get an SSA form with that, but like I say, it's been a long time since I've had to deal with unemployment benefits.
Awesome. And then next we have, what would you say are the benefits of filing as a dependent versus an independent?
Correct. So generally, this is a great question, because if you're a kid, if you let your parents claim you, they get a bigger tax write-off versus if you claim yourself because you're working part-time at whatever. Truly, it's nice in that situation. If your parents have a paid preparer, he will be able to say the better status is X, Y, or Z. Eventually, you're going to need to be doing your own 1040, and on that 1040, you more likely than not will be claiming yourself because you can and you should, because it's who you are. If for instance you're a kid and your parents are claiming you as a dependent, you need to check this box on the form. So therefore, your tax rate goes up because you don't get to claim as much here. But then again, you're paying tax at probably a low marginal rate. And if you have parents that makes substantial income, their tax rate is at a higher marginal rate. So in the United States, we have a progressive tax rate. So you pay only, say, 10% on the first, $15,000 of income. You pay 15% on the next $50,000 worth of income, and you pay 25% on everything above that. So the more you make, the more you pay. So if your parents can write you off, then you're much better off letting your parent take the deduction because their marginal tax rate is higher, and then you're stuck paying all of your own tax. Does that make sense? Okay.
Yeah, awesome.
That's another reason why you would claim on here, you'd claim 0 as a dependent. You'd be single 0, so that, if your parents are going to claim you on your return, you want to select single and 0. That way, when tax time comes around, you don't owe. So that's why you would claim 0 dependents, because you're not even going to claim yourself because your parents can claim you.
Great. Next, someone asks, what happens to money that was going into my 401k for my old job? Will I get taxed and move that to a different account, like a personal IRA? In general, am I supposed to reach out to the company, or will they?
Right, okay. So long story short, if you put money into an IRA.
Una presentación acerca de taxes. Estoy en la presentación acerca de taxes.
Okay. So on the 401k, that money shelter, that's in a 401k that stays with your old employer. Your old employer may ask you, hey, would you like this distributed? So so what should happen is, if the dollar amount is large enough, you can roll that money from your employer's 401k into an IRA, either an IRA at a bank or credit union, or you can go into an IRA investment fund at E-Trade or whatever. But you have to roll over. That's what we call an IRA, a 401k rollover. You roll it over from your employer's 401k plan into an individual IRA. That is a non-taxable event, okay? You don't get taxed on that. However, if you have a small balance, sometimes your employer will just cut you a check out of it. So what you have to do then is you have to do kind of your own rollover, which means that you take that 401k money and you go and you open it up on your own with either a bank or credit union or at E-Trade. But regardless, If you don't roll over that money into an IRA, then you will be taxed on that distribution. So when the 401k pays out anything, it's called a distribution. And you know, the distribution is either a rollover distribution, which means it's a non-taxable event, or it's a non-rollover, which means you may get taxed on it. So if your employer cuts you a check directly out of your 401k account, make sure, if you don't want to get taxed on that, to go ahead and throw it into an IRA somewhere. And then there's a form that you fill out during your tax preparation that says, yes, 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 you know, even though the distribution wasn't a rollover, you can see I've opened up this IRA, and therefore don't tax me on this rollover money. If you have money set aside in a 401k, if you're not over 59 and a half, there's a penalty on distributions if you don't roll it over. So not only will you owe tax on it, you will owe an additional 10% penalty if you don't, quote, roll over that 401k distribution. So ideally, if you are no longer employed, you want to have the employer do a direct rollover so that you don't have to worry about the taxation issue into an IRA of your choice. But like I say, if you get the money personally, make sure you open that IRA quickly, because you don't want it to be a bona fide distribution, which you owe not only income tax, but also an IRA distribution penalty.
Great. Our next question is, what is more beneficial, to do the Roth IRA or to not do that?
I have a Roth IRA. I have a regular IRA. Both of those are for previous employers' 401k distributions. When I did the Roth IRA, I was in a good position to pay the tax on the money and then roll the money into a Roth IRA. But the standard rollover distribution is just roll over to a simple IRA. If you have a Roth IRA in retirement, I will have simply a different bucket of money to choose from. So if my tax liability is low and I need money, I can take it out of my normal IRA and I'll be taxed on it at that time. If for some reason that particular year I have a high income, but I need the money, I can pull it out of the Roth IRA tax-free. Normally you're not going to run into a Roth IRA. If you want a lot of flexibility in retirement, you might want a regular IRA and a Roth IRA, just so you have two different buckets of money, one that you'll pay tax on, the other one that you won't. And obviously you'll have to, if you can afford the tax on it now, then you can do the Roth IRA rollover. But yeah, it just depends upon what the person wants in retirement.
Perfect, thank you. Next, how much income should I have through the year to be able to claim a tax return?
Okay, so like I said before, even if you have very minimal income, you still may want to file your taxes so that the information will flow to FAFSA. And you may also want to file your taxes to see if you qualify for the Earned Income Tax Credit if you have kids. So, there's no penalty for filing when you don't need to. So if you, like I say, if you want to facilitate these two things, you still may want to go ahead and file regardless.
Perfect, thank you. And then our last question was asking what is the minimum income that requires you to file? So I'm assuming that's similar to what you just said.
Right, whatever generates a tax liability is the minimum income to file. Don't know what it is off the top of my head. Definitely, if you're below the standard deduction threshold, you do not need to file, but you still may want to file because of what I discussed before.
Perfect. Okay, great. So it is 1:30 and that was our last question. So I would like to thank you again, Wesley, for being here today to deliver this presentation, and also to our interpreter and captionist for their services this afternoon, and obviously to everyone for their questions. I want to remind everyone that we will be having 3 more financial literacy events on October 22nd, 29th, and November 5th. There's more information on those events on the upcoming events page on the ASGCC website in the area entitled Upcoming Events. And I would also like to remind everyone to please fill out that form I put earlier in the chat. I will put it back in again. This will put you into the running for one of the gift cards that we'll be giving away. There's $250 worth of gift cards being given away at this event and each of the Financial Literacy Series events. So make sure to do that. And yeah, so these series will also be recorded. I heard people asking about that in the chat. They will be up on the AS website as well later on, but yeah, that won't be right after the meeting, obviously, but they will be up soon. So I want to thank you all for coming. And yeah, hopefully we see you at the rest of the events.
Thank you.
Thank you.
Thank you, Isabel. Thank you.
Thank you.
Yeah, thank you so much for
Thank
coming.
you so much.
Thank you. Thank you, Mr.
Thank you.
Wesley
You're very
Walton.
welcome.
Good information. Very good.
Yes, you're getting a lot of thank yous in the chat too, but they're coming to me, so just so you know, Wesley.
Thank you.